Auzubillahiminash-shaytanir-rajim. Bismillahir-rahmanir-rahim. Today we will talk about another topic of first chapter. The chapter title is insurance, and the topic which we'll be discussing today is principles of insurance. Some people also call it fundamentals of insurance. So whatever you call, but these principles provide the legal basis of insurance prevailing in most parts of the world. The insurance laws in most of the countries are based on these principles. So, to properly understand the regulatory framework of any insurance laws in a country, we should be able to understand these principles. So there are several principles, but I have picked a few among them which are relatively more important. The insurance contract between the client and the insurer is based on the principles of insurable interest, utmost good faith, subrogation, indemnity, and proximate cause. So, starting from insurable interest is basically the relationship between the client and the beneficiary. For example, if somebody is taking life insurance, then he should be appointing the beneficiary to be the person who is financially dependent on that person and will be financially under stress if the client dies. So that relationship is mostly with the spouse, wife, with parents, with children, and in some cases, brothers, sisters. But this relationship doesn't exist with friends, with cousins, with other people who are not financially dependent on the client. So, when it comes to general insurance, the ownership of the property creates that insurable interest. Like if I have a car, then if the car receives some loss in accident or is stolen away, then the financial loss will be for me, not for someone else. So I shouldn't be insuring car of my cousin or my friend because I doesn't own it. I don't own it. So the beneficiary must be someone who would suffer if the insured event happened. Typically, insurable interest is established by ownership, possession, or any other direct relationship. In life insurance, it's the relationship between wife and husband, between children and their parents. So when it comes to general insurance, the relationship is means this insurable interest is established by ownership, possession, or any other direct relationship. Like possession, for example, a company is transporting some goods from one place to another, and it has the responsibility of safely transporting those goods. So that transporting company can also take insurance of those goods, although it will not be owning them, but since it has its possession. Similarly, when banks mortgage property or pledge, they also compel the client to take insurance and to mark a bank as a beneficiary. Normally, a bank mortgage clause is attached to such insurance contracts. So, if somebody has taken a loan from the bank and the house is mortgaged with the bank as a collateral, then the bank asks the client to take insurance of the house, and if something goes wrong, if something happens to the house, then the first claim on the amount of insurance will be of the bank, and it will recover its loan and interest from that claim and will pass on the remaining to the client. So, in life insurance, insurable interest exists due to an established relationship between the client and the beneficiary. Like you can see, it's the same detail which I just have mentioned. So, uh, for example, a wife has an insurable interest in life of her husband and vice versa. In such a case, the husband is the client while the wife is the beneficiary having insurable interest. Beneficiary is the one who receives insurance claim if the client dies. In general insurance, the ownership of property usually indicates the insurable interest. The owner of a car or a building can take insurance for that car or building, as the owner has an insurable interest in their own property. Then comes the principle of utmost good faith. Utmost good faith requires the client to disclose all relevant material information with the insurance company so that the insurance company may take an informed decision whether to issue the insurance to the client, and if issuing, then on which terms. So, under the duty of utmost good faith, a client has to convey all the vital information to the insurer before the contract is put in place. Information is material if it may affect the insurer's decision on whether to approve or reject the request for insurance. For example, in life insurance, a person who works for police must disclose their profession to the insurer because it can affect the insurer's decision to issue insurance and cost of premium. Similarly, if somebody is taking life insurance and is diabetic or hypertensive, then and the insurance company normally asks for this information in the proposal form, and if the client doesn't disclose this information, the insurance company will consider him a healthy person and will approve his insurance request, and will fix the premium of a healthy person. So later on, if the insurance company finds that the client lied to the company and was hypertensive and diabetic at the time of insurance, and he was knowing that, still he concealed that information, then the insurance company, under the utmost good faith, has the right to reject insurance claim if the client dies. So it is very important that the client discloses all the material information that is in his knowledge to the insurance company so that the company may take an informed decision, and later on the client family and the beneficiary doesn't face any problem in getting the insurance claim. So, if somebody deliberately conceals material information, the insurer has the right to reject the claim. Normally, at the end of the proposal form, there is a declaration in which the client declares that whatever information he or she has provided, they are on facts and are true in the best of their knowledge. And if the insurance company find that information erroneous later on, it reserves the right to reject the claim, insurance claim. Then comes the indemnity principle. Indemnity basically means to protect. Insurance company, this principle applies to general insurance. It doesn't apply to life insurance. Under the indemnity principle, insurance company claim that will indemnify, will protect the client from the financial loss if it occurs through happening of any covered event mentioned in the insurance contract, and the client will be brought into same financial condition through paying claim as the client was before the loss. Like for example, if the client vehicle is stolen away and the value of the car was 10,000 USD, then insurance, then now the client has suffered 10,000 loss. So insurance company pays the insurance claim of 10,000 USD and bring the client into same financial condition as he was before the incident, that is stealing of the car. Uh, so Through the principle of indemnity, insurance companies claim to return the client maximally to the same financial position that they were in before the loss. Companies do this by paying a claim equal to or less than the equal actual loss to the client if an insured event occurs. Here, the emphasis is on compensation, which means that a client cannot get any more than the amount that he or she has lost, so that the situation doesn't lead to any conflict of interest. As if the claim is more than the loss, the beneficiary would perhaps prefer the insured event to happen. Now, here is the point that indemnity means protection from the loss. It doesn't mean making a profit out of it for the client. So, insurance companies only compensate the loss. They don't let the client to make profit out of any loss. Here comes the depreciation principle as well. Depreciation is charged on the partial loss in which parts are replaced in a vehicle. Like in motor insurance, if there is a partial accident, partial loss, and some parts need to be replaced, then the depreciation principles applies on those parts under the indemnity concept. Like for example, if the door of my vehicle got damaged and I have already used that vehicle for 3 years, then normally the useful life of a vehicle is considered to be 10 years, and it is depreciated annually by 10%. So after using 3 years my car, I have consumed 30% of its value. So if my car door is damaged and it needs replacement, then when it got damaged, the remaining life of the door was 70%. So my actual loss is 70% remaining life of the door. So if the door replacement of the door cost me say $1,000, then the insurance company will be paying me only 700 USD, not the remaining 300. I'll be bearing that 300. So this is how the depreciation concept under the indemnity principle applies. But depreciation principle only applies on partial loss in which there is parts replacement. So now life insurance is an exception because you cannot fix a financial value on the life of a person. One cannot say that, say, if the company has paid 100,000 USD to the deceased son, the insurance company cannot claim that through paying 100,000 USD, it has brought the son into same financial condition as it was before his father's death. So that's why life insurance the contracts are not considered contract of indemnity. So if the client dies and company pays the claim, it still cannot be claimed that the client's family has been returned to the same financial condition that they were in before the client's death. So therefore, only contracts of general insurance are contracts of indemnity. Then comes the principle of subrogation. Subrogation is basically an extension of indemnity principle. Say if the client vehicle is stolen and it lodges a claim with the insurance company, and the insurance company pays the claim, and later on the vehicle is found, then if that vehicle is given to the client, then the client will have double payment, will have benefit out of that incident. So, under the subrogation principle, whatever the legal right arises after paying the claim, the legal right will be owned by the insurance company. So, under the subrogation principle, if the stolen car is recovered and the insurance company has already paid the claim, then that stolen car will come into the ownership of the insurance company. So that is the subrogation principle. The principle of subrogation empowers an insurer to claim any benefit that may arise from the insured subject matter to which it is entitled to once it has paid the claim to the client. Subrogation is based on the principle of indemnity that the client shouldn't be profiting from an accident. So, if a company compensates a client in full, the client has no right to seek further compensation because the principle of indemnity says that a client cannot make a profit if the insured event occurs. Through subrogation, the insurer assumes the rights of the insured once the indemnity is paid. For example, if there is an establishment of responsibility on a third party in motor insurance other than the insurer and insured, then the insurer may assume that any benefits receivable from third party will go to the insurer if the insured is fully paid with the indemnity by the insurance. For example, in an accident, another person hit my car. Now my car is insured. I take financial compensation from my company. Now, since the other party is at fault, so getting any money from that party, that money should go to the insurance company because the insurance company has already compensated me. So the insurance company will claim that money from the third party under the subrogation principle. Now comes the proximate cause. Proximate cause is the basic cause which is responsible for the loss. So, in insurance contracts, normally the cause is mentioned which is covered. Like, for example, if there is in general insurance, the coverages are named peril coverages. For example, if the house of a client is insured, then the insurance company will be informing the client that your house is covered under from the risk of fire, earthquake, uh, atmospheric disturbance, floods, hurricanes. So these causes are mentioned. So if the loss occurs, then it's the responsibility of the client to prove that the loss occurred is one of these causes. So insurance company normally look for the cause which trigger the chain, the event which resulted into the loss. For example, if there is an earthquake and due to the shocks, the concealed wiring in the walls has damaged and it has caused short circuiting, and due to short circuiting a fire broke out and it damaged the house. Then the apparent cause is fire, but the proximate cause is basically earthquake. So if the client has taken the coverage of earthquake, fire and shock, then this loss would be covered. But if the client has only taken coverage for an ordinary fire, then it's not an ordinary fire, it's basically earthquake. So, in insurance, the basic cause that triggers the chain of events resulting in damage is called the proximate cause. For example, if an earthquake causes short circuiting in a house and this leads to the house catching fire, the proximate cause is earthquake, not the short circuit. In such a case, the claim will be considered only if the insurance policy includes cover for earthquake. So in motor insurance, insurance companies cover accidental damage. Thus, if an engine of a car stops working due to its internal fault, that won't be compensated as the covered proximate cause is accidental loss to the car, not its functioning. So these were the principles, and I hope that I have successfully managed to clarify these concepts, although they are a bit technical. But these principles provide the legal basis of an insurance contract, and they are universally applied. And since these principles doesn't violate any Sharia principles, so these principles are also followed in the kafil as well. So please raise any question. If you have, you can raise it in the comments. I'll be gladly addressing that. And if you like this video, please like it and share it with others as well, and please subscribe the channel as well, so that I may get more encouragement and motivation to record more videos like this. And I again need to say that all these slides have been taken from are based on the books, and these the books I have authored, and you may take that book and you can go through it. Thank you so much, and stay connected, and please take care.